As we have concluded 2011, we need to grade ourselves and provide guidance for 2012. Last year, you had predicted the following: some modest job creation, unemployment falling to around 9%. It actually fell to around 8.5%. Increased lending and refinancing. Continued rise of gold. It actually increased somewhere around 16% in 2011. Continued low interest rates. The Fed funds rate is still at somewhere between 0 and 0.25%. And you encourage those with attractive bond yields to continue to clip the coupons and patiently seek more offerings. And lastly, with the stock market, you had predicted that it would be a stock picker's market. And the market, as measured by the S&P 500, was essentially flat for the year. You seem to have hit things right. What grade would you give yourself?
I would give us an A-. A few clients had exposure to gold mining stocks, and those underperformed gold itself. Also, the fluctuation in the values of some corporate bonds and one oil company in particular were discouraging. But in summary, I'm very pleased how we position clients' portfolios.
What can you tell us about your feelings for 2012?
2012 is going to be an interesting year. The U.S. is going to benefit from the rest of the world's problems. In Europe, governments and banks there have too much debt. I believe there will be a financial crisis and recession there that will cause people to move more assets to the United States. If these people invest in our stock market, we'll see it rise, especially stocks perceived as blue chip safe havens or a speculative turnaround situation. However, some will invest in U.S. dollars or treasuries, and this will increase the value of the dollar, which unfortunately will cause many stocks to decline. It will be a challenging year, but I think being exposed to some stocks at the beginning of the year will offer the ability for a person to trade out of them later.
Why wouldn't Europeans instead prefer emerging markets or China?
The Chinese stock market was down about 22% last year. While I would not be surprised to see it rally some, I think it will be lower at the end of the year than where it began. Again, barring temporary rallies in the Chinese stock market, I think a recession firmly is in place in China. It will be a hard landing that could impact many emerging markets elsewhere. Investors there will probably invest in the United States. Buying American should be a better place to invest than China.
What about gold?
I still like gold. There have been instances where gold has experienced big pullbacks and still advanced. If you look at how many dollars have been printed and are being printed, there's no way a dollar is going to buy more in 5 years than it does now. So gold retreats a little more from where it is, this would be acceptable. I think one has to be patient.
You like some exposure to the U.S. stock market, disfavor foreign exposure like China, some emerging markets, and parts of Europe. You like gold. What else looks good?
I still love clipping coupons. Owning an individual bond that has a high degree of certainty that one will be able to collect interest and receive one's principal return without having to wait very long is comforting. In the 2 recessions that created the Great Depression, the people who made the most during that entire period were bondholders. People who had bought stocks in 1929 had to wait something like in the early 1950s until they got their principal returned. Ask someone in Japan today whether they think the Nikkei, which closed around 83.90, will ever return to the 1989 levels of 39,000. They'll probably tell you, only in my dreams.
What about fixed income mutual funds?
It depends who's managing the fund and how long they're managing it, and also what the approach of their management is.
Well, if the dollar rises too much, don't you think that the Fed will intervene with another round of quantitative easing?
If the stock market has declined too much and there still is enough time before the general election for the easing to make a difference, then the Fed might do that. They'll probably do something though. Only Ben Bernanke can answer that question.
I guess in times like these, it makes sense to chart a better course with Armada Advisors.